My job is to introduce the head table. So starting from my far left, your far right, I have Gordon Brady, now retired, was previously senior economist, Joint Economic Committee of the U.S. Senate. He's a member of the International Atlantic Economic Society Executive Committee. He's also a long-term member of the Atlantic Economic Journal Board. Seated next to Gordon, I have the International Atlantic Economic Society President, Charles Calamiris. He's the Henry Kaufman Professor of Financial Institutions at Columbia Business School and a visiting fellow at the International Monetary Fund. Seated next to Charlie, I have Francesco Giavazzi. He's Professor of Economics at Bocconi University. He's a research associate of the National Bureau of Economic Research, a research fellow of the Center for Economic Policy Research. He was a former advisor to the Italian government for spending review and also advisor to the Federal Reserve Bank of New York. I'll now turn the podium over to Professor Giavazzi to introduce our Robert A. Mundell Distinguished Speaker. Professor Giavazzi.
Good afternoon to everybody. I think Professor Monti needs no introduction in this group, but we all know him as an economist first, as the president of my university, Bocconi, for a long time, as a EU commissioner twice, once for the single market and once for competition, as a prime minister who was appointed when Italy was on the verge of, in my view, on the verge of default in November 2011 and managed to avoid the default and get Italy out of trouble, and currently as a senator. Mario will talk this afternoon about economic policy divergences and their cultural roots. I was very surprised by the title, as often Mario surprises me, because the role of culture on economic outcomes in general, for example, on labor market participation, and the constraints that the country's culture imposes on policymakers when they design policies, is one of the, maybe today, the most relevant contribution of Italian economists to the literature. I remember people, they're almost all in the US, but they're all Italian. Paola Sapienza at Northwestern, Luigi Zingales at Chicago, Paola Giordano at UCLA, Luigi Guiso is in Rome, and Alberto Alesina himself. These are all people who have contributed to the role of culture on economic outcomes and on policy, to the point that now for the past 2-3 years, the NBR has a special session, which actually will happen in a month, dedicated to the role of culture on economics. And so that's the first reason I was surprised that Mario sort of came right on the topic. And the second, because there could hardly be a better time to discuss the constraint that culture imposes on policy as this one, where we are struggling on how to get Greece on board again. My view that kind of Greece is no longer on board. We have to bring them on board again. And culture lies at the core of the issue, both culture within Greece and culture across Europe vis-à-vis Greece. And to give you a simple example of how to think about this issue, assume that you are an Indian prime minister and there is a serious famine in India, and you have the opportunity to save many lives by distributing food that is based on beef. And of course, you pass a law that says beef is legal in India, and that saves a lot of lives. But first, the law would not be approved, and second, even if the law would be approved, it is very unlikely that the citizen in India would go along with this and eat beef. The result would be an undesirable outcome where many children die, but it's a very good example of the constraint. And when I think about Greece today, I struggle with this, with the constraint that the current leadership in Greece has from what has developed the culture of the country and what would be ideal for the country to do. And I understand it's very difficult to do. with this too long introduction, I leave the floor to Mario to learn about the constraints of culture on economics in general.
Thank you very much. I'm really... It's not on? Okay. Yes. Thank you very much, Francesco. I'm very honored to have been invited, and also because the organizers have picked Francesco to introduce me, so it's a double honor. Yes, I have proposed a topic which is sort of intra-European: economic policy divergences in Europe and their cultural roots. But to pay tribute that this is, of course, the International Atlantic Economic Conference, I thought I should start with an anecdote, which is transatlantic. And I must say, and this anecdote as the starting point will reveal to you that I'm rather ignorantly approaching the topic, far from being a specific and close follower to the largely Italian school of economists that Francesco mentioned, investigating the role of culture in shaping economic policies. The anecdote is that when during the time I was Prime Minister, I was, as it happens sooner or later to Prime Ministers, I was invited by President Obama to go and see him in Washington. But the curious thing was that well before my trip, the US ambassador to Italy came to me to describe the scenario of the conversation with the president. And he said to me, don't be surprised if he will not begin the conversation talking about the Eurozone or Italy, because he has a more specific question for you. He will ask you, how should one approach Chancellor Merkel on economic policy issues? And loyal to the script, the president started the conversation with this. And presumably somebody had mentioned to the White House, rightly or wrongly, I don't know, that I had developed over the years, but particularly during those critical months for the Eurozone and for Italy, some not always easy but constructive understanding with the German Chancellor. And I said to him, you should be aware that for Germans, and it doesn't really matter to which political orientation they belong, for Germans, by and large, economics is still a branch of moral philosophy. And growth is the product of virtuous, morally speaking, economic behavior of the individual, of the household, of the firm, of the state. So I know that your advisor are feeding you with a lot of very well analytically based but desperately Anglo-Saxon briefings to persuade Germany to change tack, both in doing a better job in giving their contribution to the global demand and at that particular time doing a more understanding job within the European policy context to facilitate countries in Southern Europe to come out of the crisis, etc. And the president was particularly interested because that was February 2012, and in the summer and then in the autumn it was his electoral period, so he wanted to avoid, particularly from Italy, which was the first candidate in line, an eruption of the Eurozone which would have created serious problems to the global economy and also to the US. I'll conclude the anecdote by saying, so in my view, you will never succeed in a finite period of time to persuade Germans to reflate through deficit spending, etc., etc. But nevertheless, I believe that there is one narrow window of opportunity, because there is, I thought I said, as you know, a component of aggregate demand, which is bad, yes, because it is demand to German eyes, but nevertheless is less bad than demand in general, and public demand in particular, because it is capital investment demand. And so, yes, unfortunately, you should tell the Chancellor this is demand, but you know, it has the virtue that it creates future capacity to supply goods and services. And therefore, so my view of the cultural differences, divergences in Europe and their roots is that is a very pragmatic one, because I had to penetrate these things to find out where there was a little margin for maneuver. And I must say that President Obama subsequently was very, very helpful. I'm not saying because of my teachings. In the multilateral occasions we had, the G8, the G20, he did not hesitate to intervene in intra-European debates, and did so quite forcefully, because he has, we all know, quite a lot of intellectual power, and that was not without influence, I must say. But I believe that at this stage of the development of European integration, we must take into consideration what in antitrust people would call the dominant position of German policymakers and of German thinking. A dominant position that is there. We may like it or not, but it is there. It may be abused on occasions, and that the abuse of a dominant position is a red light. But I must say this abuse also, let me be frank, takes place because of the great timidity and unwillingness to speak up by so many, I discovered, politicians in Europe who, in the corridors of the meeting room in Brussels, will tell you, but you'd not agree with that German statement, would you? Yes, I don't agree entirely, but if you're so contrary, I would expect you to say this in the meeting, which is about to begin. Practically nothing does this, nobody does this any longer, which is a very, very serious problem for Europe and for Germany, because they are too much unchallenged. But at any rate, I believe that we must take into consideration that, particularly on issues like fiscal discipline, it is a bit unrealistic that one can draw an ideal rule or map or system which would not go down at all well with Germany. That simply does not have a chance to see the light. That is why I have been convinced for a long time that the way of penetrating the fortress of German conservative economic policy making is precisely through investment, and public investment in particular. This is just to give you the different concrete manifestation of this effort that I and many others did, well, back in the 1996, 1997, at the moment of forging the original Stability and Growth Pact. there was a strong body of political influence, among which myself, who I was then commissioner, who tried to use the fact that in the German constitution of that time there was the so-called golden rule, namely public indebtedness is forbidden except if it is for investment purposes. But this did not fly. Although originally the Germans in the Maastricht negotiations wanted this. Then, and this has been a very long-standing debate, then more recently in 2012, 2013, there was a minimal opening at the level of the European Council, then translated by the European Commission in a position paper, namely that the European Commission, and the Germans agreed on this, that the European Commission, in assessing the compliance or lack of compliance of individual member states to the Stability and Growth Pact rules, provided a government was below the prescribed 3% of GDP deficit ceiling, that country could be allowed to deviate by excess for a while from its trajectory towards the medium-term objective, balance or close to balance, provided the excess relative to the trajectory value was constituted of public investment. But then this opening of principle was surrounded by so many caveats that it did not really open up much. More recently, with the Juncker Commission, the matter is evolving. As those of you who follow Europe will certainly know, Jean-Claude Juncker, the new president of the European Commission, that is the executive body of the European Union, has very much characterized his first policy moves by an accentuation of investment, private and public. And it has done so both at the European Union level by promoting a rather grandiose Juncker plan for EU-wide investments, but also trying to give a more favorable regard to national public investments. In which ways? Two ways, as a matter of fact. One is that the national contributions given by individual member states to set up the Juncker Fund to then do the EU-wide investment plans, that transfer can be exempted from the Stability and Growth Pact in the accounts of the particular member state. And the other opening is that in a communication, so an official document presented in January by the European Commission, the Commission explains how certain margins of flexibility may be used in the implementation of the Stability and Growth Pact concerning the structural adjustments, concerning exceptional circumstances, concerning more leeway in terms of the budget deficit allowed if that member state is doing good progress in terms of structural reforms. And in this map of flexibilities available, public investments are given a rather favorable treatment. There is no need here to go into the details. Before I turn to the real cultural roots of the economic policy divergences, let me just briefly explain why I personally am not very fond of neither openings by President Juncker and the European Commission, although they point to the relevance of public investment. I'm not very fond concerning the exemption confined to national contribution to the Juncker plan for a number of reasons, but basically because I believe that Europe badly needs at this time more emphasis on investment, public-private partnership, private investment, and it needs to do so, in my view, through a subsidiarity movement with something being done at the center, Brussels, that is the Juncker plan, but also by an encouragement through network of a more proactive investment policies by the national member states. And if you just reflect for a second, if country A is given the exemption from the Stability Pact ceiling for the sums that it devolves centrally to the Juncker plan, but only on those sums, not on the public investments directly done at home, there is a paradox, because under the golden rule principles, the reason why it may make sense to indebt a government in order to do public investment is that hopefully that investment will generate growth in the future, hence an expansion of the tax base, of the tax revenue, and therefore will pay itself to some extent. But if country A gives a contribution to the Juncker plan, of course it cannot presume that that same money comes back, because this would be the opposite of what needs to be done under efficiency consideration. The Juncker plan should go where the best projects are. But if country A gives 100 to the Juncker plan and in the limit nothing comes back to it, and that should not be too strange, there will not be, at least initially and domestically, the growth of GDP which would justify the exemption that has been given to that contribution. And also politically, I believe that President Juncker will not be able to really get much in terms of these national contributions unless it also gives some inducement as regards the national public investments. And the other interesting avenue opened up by the Juncker Commission in this flexibility communication, this is largely at the request of the Italian and the French governments, more generally the governments of Southern Europe, which say the rules are too rigid at a time of recession or lack of satisfactory growth. They need to be interpreted with flexibility. I'm not very favorable to this either. Why? Because in European integration, a very interesting chapter would be the dictionary, and the word flexibility coming out from a southern mouth penetrates in a Nordic ear as I'm not going to seriously respect this rule. Just like I said many times to the French in particular, who love to speak of solidarity and to ask for solidarity, why call, in speaking with the Germans, why call solidarity some policy behavior suggested to Germany which would be very, very much in their own enlightened self-interest? Why should we morally indebt ourselves by having labeled as a request for solidarity something that could be justified as a request simply because, for example, maintaining the euro or the single market well, the German economy draws so many benefits? So words are an extremely interesting but also slippery vehicle among governments of an integrating system. And this communication on flexibility has more substantively one risk which is already materializing. Communication has been produced in January. Now France, with a lot of flexibility used in its case, and Italy, with much less flexibility needed in its case, have been given the green lights by Brussels. As one could have expected, a number of small member states, south and north, are saying, but this exercise of flexibility is very discretionary. The Commission uses it more generously vis-à-vis the large member states. We lose confidence in the even-handed enforcement of the rules by the Commission, which, in my view, would be, in the long run, an even more serious problem than a bit less of growth or a bit more of growth in Europe. So that's why I believe that what we need, if we want to stick to rules of fiscal discipline, and I believe we should, first, because we are an integrating system and we are not a federal state like the US. And secondly, because there is a predominance of Germany politically, and they could not live one day without those fiscal rules applied to themselves or to the others. So if we do need fiscal rules, I think we should use the window of opportunity of a more favorable treatment of public investment, needless to say, with a lot of caveats concerning what is the definition of public investment, etc., etc. All this is specified in a paper that is there, should you be interested. But then more rigorous application of more rational rules, because today I'm convinced that the request for flexibility comes up because the rules are not really very, very persuasive. But what is being the reaction of Germany to this minimal request of change in the rules with a greater understanding for public investment? It's a very, very difficult reaction. And here we come to the cultural roots, visible here in the case of public finance, but for any aspect of economic activities and policies, we could have this discussion. Well, as is by now widely known, German is the only language in which guilt and debt have just one word, Schulden, to express them. This must have some reason. And if you consider the evolution in the German constitution, as I mentioned, they had originally in their constitution the golden rule principle, but more recently they introduced what they consider more satisfactory. I believe to many economists it's a backwards step, that is the Schuldenbremse, the brake on the debt. And now if you go to Bavaria, for example, what is the objective of public finance policy of Bavaria? It is to bring to zero not the deficit, but the debt. Because the debt is bad, irrespective. I'm exaggerating, but not too much. The debt is bad, irrespective of what you do with the money that generates that debt. And there are scholars who, very persuasively in my view, reconduct these different cultural roots to different religious roots, which then left a big mark in the cultural tradition of countries. For example, Heinz Wissmann, the honorary director of l'École des Hautes Études en Sciences Sociales in Paris, he's a German, recently presented some simple ideas which I believe are very interesting. In medieval Christianity, without which we cannot understand the Stability and Growth Pact, humanity united by the original sin, interpreted as a debt to God, which Christ erased through his sacrifice. The promise of having a debt erased is only possible for those who accept it through being baptized. The management of venial sins was managed by the medieval church through technical measures which are not to be found in the Bible. It was considered necessary to organize sin, and for this purgatory was invented, which allowed for a debt to be reimbursed according to the seriousness of the venial sin. Confession was introduced at the same time to also manage venial sin. The debt could regularly be erased, therefore the threat of purgatory was reduced. The purchase of indulgences was enabled, and thus the link with the promise of Christ was removed and meant that the rich were able to spend less time in purgatory. In contrast, deadly sin is reserved to those who do not accept the promise of Christ. The Protestant Reformation represented the refusal of the forms of management of venial sin created by the Catholic Church. The focus returned to the problem of original sin. Calvin developed the notion of predestination, that some would be saved while others not. Luther, however, believed that it was a question of grace and that it was faith alone which enabled one to be saved. Protestants thus structurally try to avoid venial sin in order to never be dependent on being pardoned. These religious differences created different cultural traditions. Even if our societies are secularized, some elements remain present and explain some misunderstandings. We should not take them as eternal or impossible to change, but we should at least be aware of their origins and importance. The Counter-Reformation denounced this Protestant pride and refined the previous system of venial sin management. The Jesuits believe that human weakness is so great that it requires the Church to take care of dealing with the smaller sins. Thus, two confessional cultures have developed: the Protestant quest to be impeccable, both flawless and without sin, and the Catholic search for forgiveness. Venia. Contradictory behaviors can be seen between member states when faced with the problem of debt and solidarity. Germany can be seen to represent the Reformation, and France the Counter-Reformation. The Protestant quest to avoid venial sins can be interpreted as a sense of self-righteousness, an automatic moral, which can make it more difficult to accept the principle that society has the right to have its say. This is just one aspect of the discussion that I assure you is really fascinating when you hear this man. I will conclude by saying that take the present economic and financial situations of Germany. Germany is the limit, but also for many other member states, of governments being able to borrow at zero or slightly above or slightly below zero. Well, the Maastricht Treaty, the Stability and Growth Pact were created in order, this is the ethical contents of them, which I very much applaud, in order to protect future generations of Europeans, of Germans or Italians from the abuses of current politicians. But what happens if the market situation, which is likely to last for a number of years, not very ephemeral, is such that a government could borrow so cheaply, and at the same time that country has a clear weakness and shortage in terms of traditional or modern forms of social capital? Well, future generations will not thank the current German government for not having incurred debt through which it might have left to them a more adequate configuration by quantity and quality of productive social capital. So if the internal rate of return of a project or a set of projects can be estimated at 3, 4, 5%, it is a sin vis-à-vis future generations, not a merit, not to borrow that money. That is why, and using Max Weber's categories, the sticking to the principle of not accepting to issue debt is an example of good behavior in the, as they call it, Gesinnungsethik, in the ethic of intentions, but turns out to be a bad behavior in what they call Verantwortungsethik, the ethic of responsibility, which is similar, if you think of it, to the Keynesian analysis about the individual saver motivating by the right intention to save, but if that is done at a time when the conditions of the economy are of a certain type, there can be a catastrophic end once the fallacy of composition is removed. So I did not want to persuade this international Atlantic gathering about a specific policy proposal that is in the air nowadays in Europe concerning new types of fiscal rules, but I just wanted to give you one little example of the flavor that is needed to acquire if Europe is to make any progress in understanding, in the understanding among its different components.
Okay. So I think Mario will allow questions, first by Charles, or comments, whatever.
Well, first, thank you for that extremely interesting speech. And I can't help but note that, of course, you left out the Orthodox religion, which is another Christian religion of Europe.
Which is very much on the front these days.
So since I'm Greek and also Orthodox, I can tell you that there's a very relevant set of facts that are related to what you said, which is in Orthodoxy, we don't have original sin, we don't have purgatory, and we don't have indulgences ever, which of course may explain some of the other side of what you're talking about.
Nevertheless, the brand value of the word orthodoxy is very high, particularly in Germany.
This is general opinion that a part of the solution for a European problem should be an increase of investments in Germany. But when you think about it, isn't there a danger that this increase of investments in Germany will suck investments out of Mediterranean, which I personally believe need investments much more?
Can I? I believe that Germany and investment are two concepts that in policy terms today need to be seen at two different levels. One is investment, and specifically public investment in Germany, and you refer to that. And you consider the implications for investments in Southern Europe. That is one thing. But then there is the de facto veto power that Germany has over any possible change of the European rules about how investment, public investments are treated in the norms of behavior of all member states. But now, to your specific point, yes, there is a general consensus, including in Germany, on the need for more public investment in Germany. But by whatever side you take it, including if you speak to the great insurance companies in Germany, they complain that they have not enough material in terms of high-grade government bonds to develop all their operations. Suppose Germany follows the pressure of others, of so many others, and does more public investment in Germany, would this crowd out investment in Southern Europe? I'm not sure. There would be, at any rate, I believe, some expansionary effect through greater demand throughout the European economy. Probably what you point to would be the case should those investments done in Germany replace alternative projects for investment done by German companies or government in southern countries. But I do not believe that the capacity constraints, even in Germany, are such that the two things could not be done at the same time. But there are valiant economists at this table and in this room who may have a view on this specific point.
Thank you. There's a question. Yes.
Something in defense of the Germans.
I'm not attacking them.
Yes. And I shouldn't say anything because I'm a German, that's a problem.
But ask Italians what is my nationality and listen to their answer.
The point is, I would be a little bit careful to stick so much far back into the history and in the culture and in the religion and so on and so on. Remember, the golden rule prevailed in Germany until 3, 4, 5 years ago.
Mm-hmm.
Got the golden rule. It
Yes.
was not an accident in the history. It's a golden rule. But we had the debt break on debt since 3 or 4 years. And this is a very short period. And I don't know how to explain that by Protestantism or Catholicism or so. And I think what is behind that, from the golden rule to the debt break, is we have in economics a paradigm change, not only in Germany, but we had this paradigm change also in other countries in economics and discussions and so on. And you can find it also in the United States. I guess it comes from there, from the United States, which is more Protestant than Germany or so. So I do not know. It sounds very nice what you have told me. But when I think a little bit about that and about the past and so on, the history, well, the golden rule, it has a long tradition in Germany.
Exactly. That's why I believe that there is a certain legitimacy if the rest of Europe looks at some variants, at least, of the golden rule, because if the golden rule is the rule which presided over, for example, the whole period of Germany's economic miracle, it can hardly be said that the golden rule is a perverse and dangerous invention of Greeks, Italians, and Spaniards. To what change of paradigm, including in the US, are you referring? The increasing, because this is there, of course, both in the US and in Europe in many circles, the increasing lack of confidence in the ability of government to act decently well and decently honestly in any respect?
It has something to do with the demand. You mentioned it. Demand is bad. And because if you have demand, you have expenditure, and you don't save. And you should save.
There I was interpreting you, the Germans.
Yeah, but the idea of the supply side economics comes not from Germany.
Yes, but wasn't the supply side economics invented in Austria and Germany 1 century before it resurfaced in the US? We should be Atlantic.
Well, I have to say that I really enjoyed your speech because you tried to link religion and economics, and it's something we often don't think about. My name is Joseph Moriali, and I am from the United States, New York, but I'm also Italian, which raises an interesting conflict in me as I hear you.
I can imagine.
So, since we're at IAES, let me try this on you. If I follow your logic about the cultural bases of the differences in Europe between Protestantism and Catholicism and maybe Greek Orthodox Catholicism, then I would have to ask myself a question about if the religions have not become ecumenical, how could you ever possibly suggest that the Europeans would become ecumenical and form a single union in an economic sense, a true union where we sort of trust each other and believe in each other? Because if the churches can't do it, then I would take your thesis and say, well, it's an impossibility, or it might take 500 more years to do this, since that's the closest we've come was in this century to really bring Protestants and Catholics together. I'm curious to see how you would react to that, because it has all sorts of implications then economically for Europe. I rest my case.
I'm certainly unable to answer to the Italian in you and to the American in you, but I will simply try by saying that, and please note, I've not introduced Islam today. Also because I would not be able, and also because it does play an enormous role in some policy-making discussion in Europe, but not so far in fiscal discipline discussions in Europe. It might one day. I believe that the European construction is indeed a bit ecumenical. As you probably know, there was a big debate about 10 years ago whether the new constitutional treaty of the European Union should have recognition of the Christian, Judaic, cultural heritage of Europe or not. In the end, it was not inscribed in there. But it is at least my view and my deep conviction that that the European integration has a lot of ethical content, not simply because it helps keep peace, at least so far, which is normally considered to be better than war, but also because the building blocks of the economic policy framework of the European Union have a profound ethical byproduct at the very least. For example, the euro appears to be a highly technical, sophisticated construction for bankers and merchants. But because it has been born surrounded by a number of rules, very much at the will of the Germans, the euro is the thing that imposes on national governments in Europe to be more respectful of future generations, of their citizens, rather than doing what predecessor governments in Italy, in France, more recently even in Greece, did, namely to satisfy all concomitant demands in society at a given moment in time, simply to put the burden on future generations through public debt. I think this is an element of intergenerational solidarity, which is normally appreciated very much by various religions. This is just one example, but it may well be that under the impact of a severe economic crisis, as we've seen in the last few years, the divergences in perceptions grow bigger, and there has been a huge divide created between North and South recently, and that the fundamental cultural tradition of the different countries, do not call them religious tradition perhaps, do come up and play a big role.
Can I ask about the microphone?
Yeah.
Can I ask about the public sector investment, which seems to be at the centre of your thinking here? What exactly does this mean? Europe is littered with roads that go nowhere, mothballed airports and trains with nobody on them and that kind of thing. What are you in fact saying? Is this really any better than just, you know, the Keynesian idea of filling bottles with €500 notes and digging them up again?
I thought I had distanced myself from John Maynard Keynes dangerously too much. No, I'm not thinking of those policies, but you have certainly a point, and in my view, it incumbs upon anybody making proposals for a greater role of public investment to address a number of issues, and I believe that an important contribution that at this time the European Union and the European Commission could give, accompanying the Juncker plan, is to help the culture of investment develop in Europe. For example, what is the productive character of an investment, the type of investment, the nature of investment? Should the EU encourage any kind of infrastructure or define a very limited framework? For example, projects that contribute to a carbon-free society. I'm not sure you would pick that one, but what about investment in human capital? The the risk of hijack, how to avoid subsidies to sectors that are not future-oriented, hidden state aids, the accompanying measures. So of course, something on which Francesco Giavazzi has written a famous book in Italy recently, The Risk of Corruption and How to Go About That. I do not believe that because there are all those fogs around, all those risks in the notion of and the practice of public investment, I don't believe this is a sufficient reason to have policymakers stay away from public investment, because I believe there is, I mean, Europe may be full of roads which begin and do not end, but Europe is also full of lacking situations which lack energy, transport, telecommunication, interconnections among member states. So I do not believe that our modern society should scare itself and abandon public investment altogether because of these difficulties. Although, of course, one should, in my view, develop as much as possible public-private partnership. But something that will, and then I shut up, will be of interest to Francesco Giavazzi. Apparently what the Juncker plan does in the willingness to help Europe through this plan for investment is to put the very scarce money of the EU budget into instruments and modalities that could guarantee the private sector and therefore leverage in much more investment efforts, financing for investment efforts. Yes. Where does the Commission go to pick up some of the scarce money? 2 chapters. The budget for interconnections and the budget for fundamental research, not applied research. That is, it's Europe renouncing to the rather small role that it has to produce a European public good, which is to foster research with a very high risk because it may not give results.
Yes, Professor Monti, I would like to ask a question that is somewhat unrelated to the broad cultural discussion you have so well provided for us. My question is about maintaining order and creating binding decisions and enforcement of agreements in the EU. What are the real powers of the Commission President vis-a-vis the members?
The Commission is a college of members, not in a very scarce number. They are currently 28. Over time, the President has seen its powers increased by law or treaty and de facto. The present President of the Commission, President Juncker, is also experimenting with a new organizational setup within the Commission. He has appointed 6, I guess, vice presidents, but not simply with decorative functions. He put each of them, and normally they are former prime ministers. It is believed that this should carry a special authority. And they have been put in charge, one could say, of clusters of commissioners competent for the different portfolios, which may create some additional confusion or may produce a more orderly or and streamlined flow of decision making. I believe it's a bit too soon to tell.
Okay, thank you.
Okay, there is we are beyond the time, but certainly there's time for one last question.
Okay, thank you. Well, as a British Catholic, I've got a rather British question rather than a typically Catholic question. I mean, I agree with my colleague about the merits of public versus private investment. In the UK, we had a very successful period of private development of infrastructure up until 1939, and an incredibly unsuccessful period after 1945 of public sector infrastructure investment. But my main question really is about the EU role here. Some of these things may be European-wide public goods, but they're no more Europe-wide public goods than they are national public goods or global public goods. And it seems to me that the EU getting involved in these issues of individual country investments through EU borrowing and promotion of these projects is just sort of mission creep by the European Union. There is no reason, except maybe with a very small number of issues, for the European Union to be involved in these kinds of projects.
Yes, when we are speaking of more public investments in member states, we are not normally speaking of EU-financed public investments in member states. We are talking of, if it is public investment, investment financed by the government of that member state. To your question, then, why should the EU at all be concerned about, be involved in this? Well, it is involved because of the rules for fiscal discipline, which are rules decided by the member states together in the European context, and the member states have delegated to the European Commission, to the Council, the power and the duty to oversee whether these rules are respected. And the rules about fiscal discipline have also an implication for public investments. This is why it's not to overemphasize the role of the European Union that one says there should be some change in the EU-administered rules if member states, and then one may disagree or not, should have more leeway for public investment. From the beginning of your question, you spoke as if we are already beyond 2017, and you took a rather politely distant and extraneous approach to the rest of us here in the European Union.
Thank you. So with this forward-looking thought to beyond the British elections, I think we can close, and I'd like to invite you to join me in applauding Professor Monti for his very nice hour with us.
Thank you so much. And if you'll bear with me just one more moment, if I could have our distinguished speaker join me at the podium for just a moment. A little something for you from the Society, since you honored us by speaking. So I'll read this out loud. It says, Mario Monti is hereby designated a Distinguished Associate of the International Atlantic Economic Society in recognition of his outstanding contributions to economics, March 2015. Thank you very much. I have a little piece that you use. Thank you very much, and we now have a refreshment break in upstairs again in the Baron 1. Thank you.